Alright, welcome to lesson 6, everyone. In the first 5 lessons, we've been through all the fundamentals of trading. You've learned about the different technical indicators, moving averages, support and resistance, position sizing. So now it's time to put everything you've learned together into a trading system. And this is a swing trading system known as the bounce strategy. And it's a trading system that I've used for many, many years, and it's one of the most powerful systems with the highest probability. So let's understand the concept behind this first trading system. So this is a short-term swing trading strategy that seeks to buy high momentum stocks as they bounce off key moving averages during temporary corrections on a confirmed uptrend. So do recall that when a price is on an uptrend, it doesn't move up in a straight line. They go through what we call wave patterns, where they go up, we call it the impulsive wave. They retrace or pull back before going higher. They pull back, they go higher. They pull back, they go higher. So every time it pulls back, it's known as a retracement. It has a tendency to retrace to one of the moving averages. So for example, in the case of this stock, you can see it retraces to the 50 moving average, which is the blue line. All right? And every time it retraces to the 50 moving average, it would have a bounce off the moving average, like so, before continuing the trend. So we aim to buy as the stock is bouncing off the moving average. Okay? Now conversely, we sell short, weak momentum stocks as they bounce off key moving averages during temporary rallies on a confirmed downtrend. So on the right, you see a stock on a confirmed downtrend. So again, in a downtrend, prices don't go down in a straight line. They will go down, we call it the impulsive wave. They will rally temporarily and go down again, rally and go down again. And again, oftentimes on a clear downtrend, the price will tend to rally towards a key moving average where it finds resistance before continuing the downtrend. So the idea is to enter a trend during a corrective pullback, either on a dip of the uptrend or the rally of the downtrend, in anticipation of the dominant trend to continue, either down or up. And we aim to exit the trade before the next corrective pullback in order to capture at least a favorable risk to reward ratio of 1:2. So one of the keys of this strategy is to identify specific candlestick patterns, price action patterns that indicate that a bounce is reliable. All right? So we're going to study specific price action patterns right now. So let's begin with the long candle reversal patterns or long setups when it's on an uptrend and it's bouncing off the moving average. Okay? So there are two kinds of patterns we look for. The first would be we look for two candle reversal patterns. As the name implies, this involves two candlesticks. Next, we also can look for single candle reversal patterns that involve one candlestick. So let's begin by looking at the two candle reversal patterns and when they confirm an entry. All right? So take a look at this graphic over here, and what you see is a two candle reversal pattern, which involves two candles. All right, let's call this candle 1 and let's call this candle 2. Now candle 2 is known as the reversal candle because it is the candle that so-called bounces off that moving average. Okay, candle 1 is the candle before the reversal candle. Okay, now we're looking for a specific criteria for this to be reliable. Now here's the criteria. First of all, the reversal candle is a candle where its body is above the moving average support, and the lower shadow of the candle extends below the moving average support. So in other words, for this reversal candle that you see, right, the body of the candle must be above the moving average, and the lower shadow must cut below the moving average. All right, so that's the first criteria. Next, the lower shadow of the reversal candle must also cut below the low of the previous candle. So let me explain that. This is the previous candle, right, which is candle 1. Where's the low of candle 1? The low is over here, right? That's the low of candle 1, which I will indicate with a dotted line. All right, so can you see that dotted line? That represents the low of the previous candle, or candle 1. Okay, so the lower shadow of the reversal candle has to cut that dotted line for it to be a valid pattern. So let me repeat what I just said. There are altogether 3 things that must happen for this to be a valid 2-candle reversal pattern. Number 1, the body of the reversal candle must be above the moving average. Check. Number 2, the lower shadow of the reversal candle must cut below the moving average. Check. Number 3, the lower shadow of the reversal candle must cut the low of the previous candle, which is represented by this dotted line. Check. So if you have these 3 criteria checked off, that is a valid 2-candle reversal pattern. Okay? Now, once you have that 2-candle reversal pattern, it should be followed by a confirmation candle. The confirmation candle must be a bullish candle that makes a higher low than the low of the reversal candle and close higher than the high of the reversal candle. Okay? So after you have these 2 candles, you must have the confirmation candle. So again, what's the criteria? The confirmation candle must make a higher low than the low of the reversal candle. So this is the low of the reversal candle. The confirmation candle must make a higher low than this low. Check. Next, the confirmation candle must close above the high of this candle. Check. Why is this important? Because that indicates that the bounce has indeed reversed. We need the confirmation candle to tell us, hey, we have bounced and we are going up right now. All right. So over on the right, you see an actual candlestick on the chart showing this pattern. All right. So let's take a look. Now, is this a valid 2-candle reversal pattern? What are the 3 criteria? Criteria 1, the body of the reversal candle must be above the moving average. In this case, it's the green moving average, which is the 150. Check. Next, the lower shadow of the reversal candle must cut the moving average. Criteria 2, check. Next, the lower shadow of the reversal candle has to cut the low of the previous day's candle, shown by the dotted line over here. Does it? Yes, it does. Check. So that is a valid 2-candle reversal pattern. Now, it must be followed by a confirmation candle. So, is this a valid confirmation candle? Well, does it make a higher low than the low of the reversal candle? Yes, it makes a higher low. Check. Does it close higher than the high of the reversal candle? Yes, it does. Check. There we go. So this is a valid 2-candle reversal pattern with a confirmation candle. Right? So if you are not 100% clear on that, do review what I just said till you get clear. This is a very important pattern that you have to understand. Now, here are some common questions I get asked by students. The question would be things like, does the color of the candle matter? All right. Now, for these 2 candles, the color doesn't matter. What matters more is the specific pattern. So in other words, this could be a bearish candle. This could be a bearish candle. This could be a bullish candle. This could be a bullish candle. It could be bearish and bullish, or bullish and bearish. The color doesn't matter. But for the confirmation candle, it must be a bullish candle for this particular long setup when we're going long. Okay, so I repeat, the confirmation candle must be a bullish candle. But the 2 candles that make up the reversal pattern do not have to be any specific color. All right? All right, now let's look at other variations of the two candle reversal pattern. So what you've just learned is the original two candle reversal pattern, right? It's your KFC original recipe, right? Which again involves these two candles, right? Again, remember what are the rules? All right, this is the reversal candle. This is the candle before the reversal candle. So rule number one, the body of the candle has to be above the moving average. Check. The lower shadow of the candle has to cut below the moving average. Check. The lower shadow of the reversal candle has to cut below the low of the previous day's candle, as shown by the dotted line. Check. Right? That's what we just learned. Okay? Now, this is another variation of that two candle reversal pattern. We call it the inside bar two candle reversal pattern. So in this situation, you find that the reversal candle, which is this guy over here, is an inside bar of the previous day's candle. Okay? Now remember, what is an inside bar? An inside bar is a candle whose range is fully within the range of the previous day's candle. Okay? So this candle, the range is from here to here. That's the range, right? From the top to the bottom, that's the range. And this candle is fully within the range of this candle. So we call this the mother candle, and we call it the baby candle. This is a inside bar. Now this pattern is also a valid reversal pattern. But for this pattern to be valid, both lower shadows have to cut the moving average. Okay? Both have to cut the moving average. However, in this case, only the reversal candle's lower shadow has to cut the moving average. The lower shadow of this candle does not have to cut the moving average. Now, if it does, that's fine, but it doesn't have to. But in this particular case of an inside bar pattern, they both have to cut the moving average support. All right? Now, the third variation is the two candle reversal trade through pattern. Now, notice that for the first two patterns, the body of the candle is above the moving average. Only the lower shadow cuts the moving average, right? For this particular variation, notice that the body of the candle is cutting through the moving average. That is why we call it a trade through pattern. Now, for this particular pattern, the color is very important. It must be a bearish candle followed by a bullish candle. Okay? Whereas in the first two patterns, the color did not matter, as I mentioned earlier. Okay? So in this instance, the first candle must be a bearish candle, which opens above the moving average and closes below the moving average. And the second candle must open below the moving average and close above the moving average, showing that it has traded through the moving average. Okay? And again, some people would ask me this question. Now, which moving average are you talking about, right? And the answer is it can bounce off any of the key moving averages, the 50 moving average, the 100 moving average, the 150 moving average, or the 200 moving average, all right? But it has to bounce off one of the key moving averages for it to be a valid setup. Now, again, feel free to rewind this video and watch this as many times as you can till you understand the concept behind the two candle reversal pattern. And I always find when you're learning this for the first time, it helps if you actually draw it, right? If you draw it, you better understand than just looking at it, right? So once again, there are three variations of the two candle reversal pattern. The original pattern, which you see here, the inside bar pattern, and the trade through pattern, right? So let's take a look at some charts and see if you can identify which pattern it is, okay? So in this case, you can see the price is going up. That's an impulse. And it goes through a retracement or correction. And it bounces off the 50 moving average, right? Which is the blue line, before continuing higher. So can you tell me which of the two candle reversal patterns does this represent? Is it the original pattern? Is it the inside bar pattern? Or is it the trade through pattern? Take a minute and take a look at it. Can you see it's the trade through pattern, right? Why? Because in this case, the body of the candle, the body is cutting through the moving average. So it's a trade through pattern. And for the trade through, remember that it has to begin with a bearish candle that opens above the moving average, closes below the moving average. Then the next candle opens below the moving average and closes above the moving average, showing us that a reversal has happened, right? The bears wanted to bring the stock below the moving average, the bulls brought it back up again. So that's a very powerful reversal in sentiment, right? Now, following that, we need to have a confirmation candle. And again, the confirmation candle has to be a bullish candle if we're going long. And what's the criteria? The confirmation candle must make a higher low than the low of the reversal candle, right? So this low is higher than this low, showing us the price has reversed up. Next, the confirmation candle must close above the high of the reversal candle, right? So this is a valid two-candle reversal pattern that has been confirmed. All right, let's take a look at this other example. Nano again, so price is going up. That is the impulse in the direction of the trend. The price retraces and bounces off the 50 moving average. Okay, and then continues going up. So again, could we have taken that trade? Now, which pattern does this represent? Is it the original pattern? Is it the inside bar pattern, or is it the trade through pattern? Take a couple of seconds to take a look. Which pattern, right? Compare your notes. And this should look like the original pattern, right? Because in the original pattern, like I said, the color of the candles don't matter. All right. So what are the criteria? Again, criteria 1, this is the reversal candle, and that is the candle before the reversal candle. So this is candle 1, that's candle 2. So what are the criteria? The body of the candle must be above the moving average that is bouncing off. Check. The lower shadow cuts the moving average. Check. The lower shadow cuts the low of the previous day's candle, represented by this dotted line which I'm drawing right now. So does this low cut this low? Yes. Check. There you go. It's a valid two-candle reversal pattern, which means that there's a high chance we are going to bounce, okay? Now, this must be followed by a confirmation candle. So is this green candle a confirmation? Okay, does it make a higher low than the reversal candle? Yes, it does. Check. Does this candle close above the high of the reversal candle? Yes, check. There we go. All boxes are checked. It's going to go up. So we'll place a buy order just above the high of this candle and a stop loss somewhere below the low of this candle. And you can see the next day, we had an inside bar. They did not trigger this buy order, but the next day, the price went above the high, triggered the order, and we're in the trade riding that uptrend very nicely, okay? Okay, so we looked at two candle reversal patterns that involve two candles. The next pattern is a single candle reversal pattern. Now this is a lot easier, obviously, right? And the single candle reversal pattern is always a bullish pin bar, which you've learned under candlestick patterns, right? So it's a bullish pin bar where the body of the candle is above, once again, the moving average. And the lower shadow of the candle is extending below the moving average. So again, you can see over here, this is a single candle reversal pattern. So if you see a bullish pin bar, recall a bullish pin bar always has a small body and a long lower shadow. That by itself is a sufficient entry, okay? So the body of the candle must be above the moving average. Check. The lower shadow must cut below the moving average. Check. That's a single candle reversal pattern, right? So this is a lot simpler. Now, the reversal candle, again, must be followed by a confirmation candle. The confirmation candle must be bullish if we are going long, obviously, right? And the confirmation candle must make a higher low than the low of the reversal candle and close higher than the high of the reversal candle. Okay, so confirmation candle, is it bullish? Yes. Does it make a higher low than the low of the reversal candle? Check. Does the confirmation candle close above the high of the reversal candle? Check. There we go. All boxes are checked. The price is likely going to bounce up. So we can go long, right? So let's take a look at this example over here, right? So price goes down. There we are. That's our single candle reversal pattern, which is a bullish pin bar. So the body of the candle is above the moving average. Check. Lower shadow cuts below the moving average. Check. There we have it. Is this a confirmation candle? Is it bullish? Yes, it is. Does it make a higher low than the low of the reversal candle? Yes, it does. Check. Does the confirmation candle close above the high of the reversal candle? Yes, it does. Check. All boxes are checked. We can go long. So we place a buy order a few cents above the high of the reversal candle. And you will learn later on where to put a stop loss, which could either be at the low of the confirmation candle or at the low of the reversal candle. The next day, the price goes above the high, triggers our buy order, and we're in the trade going long. Now, a common question I'm asked is, again, the reversal candle, which in this case is a bullish pin bar, must it be a certain color? No, the color doesn't matter. It could be a red or green candle, as long as it's got a small body with a long lower shadow, that's valid. Okay? In fact, any of these four candlestick patterns are valid single candle reversal patterns because all of them are bullish pin bars. Okay? So you can have this one, which has a classic small body with a long lower shadow. You could have this one, small body, long lower shadow with a small little upper shadow. You could also have this, which is basically a doji with a long lower shadow. Remember, a doji is one where the candle body is one line because the open and closing price is the same price. So it's just a one line body. All right, and this has no upper shadow, just a one line body with a long lower shadow. All right, so any of these constitute a single candle reversal. But again, it must be followed by a confirmation candle, which must be bullish in this case. Okay, there we are. All right, so let's take a look at some examples. This is our Jan, and you can see the price is on an uptrend. This is a strong impulse going up, and the price retraces to, once again, the 50 moving average. And as it retraces, what happened? We have a bullish pin bar that bounces off the 50 moving average. So is this a single candle reversal? Let's check. Is the body above the moving average? Yes, check. Is the lower shadow cutting the moving average? Check. There we have a single candle reversal. Now, we need to have a confirmation candle the next day. Is it a bullish candle? Yes, it is. Does it make a higher low than the low of the reversal candle? Yes, check. Does the confirmation candle open and close above the high of the single candle reversal? Yes, check. There we go. All boxes are checked. We can go long. So we put a buy order just above the high of that confirmation candle. The next day, the price goes above the high, triggers our order, and we're in the trade as it continues going up. Pretty straightforward, right? Let's look at another example over here, MTD. So again, price goes up on an impulse, retraces. Now this time it retraces and bounces off the brown line, which is in this case the 100 moving average. So it can bounce off any of the moving averages, okay? So as it bounces off, what do we get? That's right, we get a bullish pin. Bullish pin bar, that's a single candle reversal. Okay? The body of the candle is above the moving average. Check. Lower shadow cuts below the moving average. Check. Valid reversal candle. Now the next day, is this a valid confirmation candle? Is it bullish? Yes. Does it make a higher low than the low of the reversal candle? Yes. Check. Does it close above the high of this reversal candle? Yes. Check. Again, all boxes are checked. We have a confirmation. So buy order right above the high of this candle. Stop loss either the low of the confirmation or the low of the swing low candle. Next day, the price exceeds the high, triggers our buy order, and we're in the trade. Okay? So that's a single candle reversal pattern. All right, so we've looked at all the long candle reversal patterns, which means bouncing off the moving average as it continues its uptrend. Let's look at the opposite. Now we're going to go short. We are shorting it on a downtrend, but we're going to short it when the price rallies, okay? When the price rallies to a moving average resistance, hits it, bounces off, and we're going to short it as it comes down. Rallies, bounces off the moving average resistance, short it as it comes down. So we're going to look at specific reversal patterns of the moving average. All right? So once again, there are two kinds of patterns you can look at, right? The first pattern is the two candle reversal pattern with a confirmation. Now it's exactly the same thing except it's the inverse of what we just learned. So let's take a look at this short setup. Okay? So again, the two candle reversal pattern includes two candles, right? It's made of a two candle pattern. So we have got this candle, which is a reversal candle. Let's call that candle 1. And the candle before the reversal candle, let's call that candle 2. All right. So for it to be a valid two candle reversal pattern, there are a few criteria that must be met. First, the reversal candle must be a candle where the body of the candle is below the moving average resistance. And the upper shadow of the candle extends above the moving average. Okay? So let me show you what that means. So what it means is that the reversal candle, the body of the candle must be below the moving average. Right? Check. Criteria 1. Criteria 2. The upper shadow of the reversal candle must cut the moving average. Criteria 2. Check. Okay? Next. The upper shadow of the reversal candle must also cut above the high of the previous day's candle. Now, where's the previous day's candle? Here. Where's the high? That's the high of the previous day's candle, shown by this dotted line, which I have drawn. Imagine there's a dotted line. So the upper shadow of the reversal candle has to cut the dotted line. Criteria 3, check. So once you've got the three criteria, it's a valid two candle reversal pattern. Okay? Now, the reversal candle must be confirmed by a confirmation candle. Now, when you're going short, the confirmation candle obviously must be bearish. It should be a red candle. And this bearish candle must make a lower high than the high of the reversal candle and close lower than the low of the reversal candle. Let's look at it step by step. Okay? So, is this a confirmation candle? Well, it must be bearish, right? It's bearish. It must make a lower high than the high of the reversal candle. So this high must be lower than this high, right? Check. Next, the confirmation candle must close. Recall, this is the open and this is the close. Must close below the low of the reversal candle. Does it close below the low? Yes. Check. It's confirmed. It's going down. We can short it. Why? Because that tells us that the reversal has been confirmed and is now going down. Okay? So if you take a look at this price over here, you can see the price going up and you can see the two candle reversal. All right? The body of the reversal candle is below the moving average. Check. The upper shadow cuts the moving average. Check. The upper shadow cuts the high of the previous day's candle, which you can draw an imaginary dotted line. So does the upper shadow cut the high of this candle? Yes, check. There we go. That's a valid 2-candle reversal pattern. Next, is it followed by a confirmation candle? All right. Is this a bearish candle? Yes. Does it make a lower high than the reversal candle? Yes. Does it close below the low of the reversal candle? Yes. Check, check. There we go. That's a confirmed pattern, right? So that's what we're looking for. All right. So just like the long setup, for the short setup, again, there are a few variations of the 2-candle reversal, right? And the first variation is the original KFC recipe, which I prefer to the spicy. Okay, so that's the original pattern we just learned, okay? Which is you have the reversal candle and the candle before it, right? So that's candle 1, that's candle 2. Again, let's review the criteria. The reversal candle must have the body below the moving average. Check. The upper shadow must cut the moving average. Check. The upper shadow of the reversal candle must cut the high of the previous day's candle, shown by this dotted line. Check. Once you have the 3 criteria, it's a confirmed 2-candle reversal pattern. And again, it must be followed by a confirmation candle that makes a lower high, and close below the low of this candle, right? Again, common question. Does the color of these 2 candles matter? No, right? It could be a bearish followed by a bearish candle, or a bullish bearish, or bearish bullish, or bullish bullish. The color doesn't matter. What matters is that pattern, which I just described. But the bearish, or rather, but the confirmation candle must be bearish, right? That is a must, okay? Now, again, we have got the inside bar pattern, where in this case, the reversal candle, which is this guy, right? This reversal candle, is now an inside bar of the previous candle, right? So it's an inside bar, right? The range is completely within the range of the previous candle. This is the mother, this is the baby, right? So this is also a valid pattern, but for this pattern, both upper shadows must cut the moving average. Whereas in this pattern, only the reversal candle shadow must cut the moving average. This shadow does not have to cut the moving average. If it does, fine, no worries, but it doesn't have to. But for this pattern, both of them have to cut the moving average for it to be valid. Okay, there you go. Both candles testing the moving average. The next variation is again the trade through, where the moving average is cutting the body of both candles. And once again, for the trade through, the color of the candle becomes important. It must be a bullish candle followed by a bearish candle. Why? We want this candle to open below the moving average and close above the moving average. Bulls are bringing the price high. Followed by a bearish candle where the price opens high above the moving average and closes below the moving average, showing a reversal in sentiment. So it must be a bullish candle followed by a bearish candle. This is for the trade through. And again, it must be followed by a confirmation that must be a bearish candle. All right? So these are the variations of the short candle reversal pattern. Again, if it sounds confusing at first, that's pretty normal. Review this video as many times as you need to. Draw it out. That's the best way to understand, one step at a time. And once you get a hang of it, it's pretty simple. All right? All right. So let's take a look at what it looks like on the charts. And you can see that in this case, the price is rallying and hitting the 100 moving average shown by the brown line. So that becomes a resistance, right? So is this a 2-candle reversal pattern? Let's check it out. This candle 1, and candle 2. So this is the reversal candle. This is the candle before the reversal candle, right? So the body of the candle is below the moving average. Check. The upper shadow cuts the moving average. Check. The upper shadow cuts the high of the previous day's candle, shown by this dotted line that I draw. Check. There we have. This is a 2-candle reversal pattern, right? So is this the original one? The inside bar or the trade through? That's right, it's the original pattern, right? Great. And the 2-candle reversal pattern must be followed by a confirmation candle, okay? Now, is this a confirmation candle? No, it's not. Why? Because it makes a lower high, right, than the reversal candle, but it doesn't close below the low of the reversal candle. Can you see? It opens here, it closes here. So it doesn't close below the low of the reversal candle. So it is not a confirmation candle. So you have to wait for a confirmation candle to appear before taking the trade, right? So this is not a confirmation candle. Now the next day, it confirms, right? Because the next day, what happens? The next day, the price opens here and closes below the low of this candle. So it shows that it has now reversed, right? And we can take a trade by placing a sell order here and a stop loss here to capture the trade going down. And again, I'll show you exactly where to place your entry price and your stop loss orders in the next part of the lesson. All right? All right. So just like the long setups, we have got the 2-candle reversal patterns. It can be a bit confusing at the beginning, right? But we have the single candle reversal patterns. And these are, again, a lot easier to understand because it's just only one candle, right? So the single candle reversal pattern is a bearish pin bar, which you have learned in the lesson on candlesticks, right? So what's a bearish pin bar? A bearish pin bar is a candle with a small body and a long upper shadow, right? Now, there we have it. That's our bearish pin bar. Okay? Now, what are the criteria? For it to be a valid reversal candle, the body of the candle must be below the moving average, and the upper shadow of the candle must extend above the moving average. So again, body below the moving average. Check. Upper shadow cutting the moving average. Check. That is a valid single candle reversal. And it must be followed by a confirmation candle. And again, if you're going short, the confirmation candle must be bearish, right? So it must be followed by a bearish candle, okay? And the confirmation candle must make a lower high than the high of the reversal candle, okay? So this high must be lower than this high, showing you that it's coming down. And the confirmation candle must close lower than the low of the reversal candle. So that's the open, that's the close. It must close below the low of this candle. Check, check, with a confirmed reversal. All right. So take a look at this chart over here. You can see it retraces, and we have a bearish pin bar. Okay. So is it a reversal candle? Is the body below the moving average? Yes, check. Is the upper shadow cutting the moving average? Check. Is it followed by a confirmation candle? Is this a confirmation candle? Is it bearish? Yes, it is. Does it make a lower high than the high of the reversal candle? Yes, check. Does it close below the low of this candle? Yes, check. All boxes are ticked. It's a confirmed single candle reversal with a confirmation. We can go short. All right? Again, revise this as many times as we need to. I can't emphasize that enough. So all these are valid single candle reversals because all of them are bearish pin bars. Again, what's a bearish pin bar? You've learned under the chapter on candlestick patterns. They must have a small candle body, like so, with a long upper shadow that makes up 2/3 the range of the whole candle, right? So it can look like that, it can look like that, it can look like that, it can look like that. Any of them are valid single candle reversal patterns. Okay. Now again, question, does the color of the candle matter? No. It could be green, white, red, purple, doesn't matter. But the confirmation candle must be a bearish candle. All right. So here's an example on the stock Kim. Yeah. So the price is going down, right? It's riding the downtrend, and it retraces, rallies to the 50 moving average. So can you see it hits the 50 moving average with a single candle reversal? Is the body below the moving average? Yes, check. Is the upper shadow cutting the moving average? Check. There we go, single candle reversal, right? Next, is it a confirmation candle? Does it make a lower high than the high of this candle? Yes, check. Does it close below the low of this candle? Yes, check. There we go, confirm. So we can put a sell order just below the low of this candle and a stop loss, either the high of the confirmation candle or the high of the reversal candle. The next day the price goes below the low, triggers the sell order, and we are in the trade going down, making money, hitting our target profit, right? So in this first part, we have learned about the specific candlestick patterns we must see when it is bouncing off the moving average, both on the long side and the short side. Please revise this as many times as you need to, and once you're clear about this, we'll go to part 2. We're going to learn specific entry rules. All right? So I'll see you in the next part, but do get this clear first.